All right, why don't we go ahead and get started? So thank you guys very much for joining. My name is Mark Lamonica. I look after the individual investor team from Morningstar here in Australia. Today, we're going to talk a little bit about real estate, so mostly listed property that we can, of course, purchase through the markets. But first, if anyone would like to follow us on Instagram, that would be great. You can see our Instagram address right there. And then, of course, listen to our podcast. All right, great. So we need to go through a couple housekeeping items first. So number one, anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. Also, if you're over in New Zealand and you want to see a copy of our FAP, then simply go onto our website, morningstar.com.au, and you can get it there. And also, the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you would like personal advice. The other thing is, if you have any questions, send them through. I think it makes it more interesting to have questions, so you can shoot those through. And this week, for people interested in other webinars, we're actually going to send out a reminder email of this on Thursday. But we've got two Thursdays, so at this 1 o'clock Sydney time slot, we are going to talk about small cap and micro cap investing. And then in the evening, we're going to talk about how much money you need for retirement. So, which should be applicable to people who are not retired or retired. We'll try to include everyone. All right, let's get started. So, listed property. All right, property investing without the property. So first, let's talk a little bit about property investing in general. So obviously, a very popular thing in Australia. Very popular because property has done very well from a price appreciation standpoint. But of course, when you are investing in individual property, I will do that. When you're investing in individual property, there's a couple things you confront, of course. Number one is because property prices have gone so well, gone so great, I guess. The down payment that you need is obviously pretty large. And because property prices have appreciated a lot faster than rent has, in many cases, you are cash flow negative with those properties. Now, of course, depending upon your tax situation, there is negative gearing that can help you out, but it makes it difficult to actually invest. The other problem that you run into, of course, is that you are not in any way diversified if you are going out there and buying an individual single family home or an apartment and renting it out. Now, why are you not diversified should be obvious. Unless you have a lot of money, you need a lot of money just to buy one property. Unless you have even more money, it's very difficult to buy multiple properties. So what are some of the things that you would need to worry about? And all of these issues, of course, have kind of gone by the wayside because of how great property is done, but it doesn't mean that they are still not issues that you face. So number one, very location specific. So number one, we've seen different, I keep saying number one, we have seen different levels of appreciation depending upon where you live in Australia, but it also can be very specific just around certain suburbs, and things obviously become more popular, less popular. Also, if people have been reading the paper lately, the government's starting to get concerned at property price appreciation and the fact that there are lots and lots of people that are being priced out of the market. And so there has been talk, particularly from around the RBA, in potentially trying to slow the property market down. So if we go over to New Zealand, we've seen the impact of that. So that's occurred in New Zealand, where they have adjusted certainly ratios you can get in terms of how big of a loan you can get based on your income. Things like that can cool the property market down. So I still think, well, we will see what happens. I'm not going to predict what the government will do, but they are talking about it, and a lot of authorities like the RBA are talking about it as well. So we're going to look at the other side. It's a ability to get exposure to property, and there are some good things about property without having to buy a single family home or an apartment. At least not just one of them. Okay, so let's do a definition. So we're going to talk about the real estate sector today. So we divide the share market up into lots of different sectors where we group companies that have similar characteristics. So there's really two different sides of the real estate sector. There's this first bullet point is there are companies that are engaged in real estate in general. And then there's a second bullet point. Those are direct owners of real estate. So that's what we're going to talk about today, real estate investment trusts. So REITs, called A-REITs in Australia, the A being for Australia. And across different sectors, we can have diversified REITs that own property across lots of different sectors. But when we're looking at sectors, we generally look at healthcare facilities. We've got hotels and motels. We've got industrial, office, residential, and then retail. So we'll take a look at all of those. And just to let you know, real estate sector is not huge globally. Australia, certainly bigger than other countries. So yeah, 7.4% in Australia. So that's of the total Aussie share market, and that's market cap weighted. And then in the US, a little over 3%. So we're not talking about huge sectors, but there are some very specific qualities around the real estate sector that make it interesting for us as investors. All right, so we don't go through all of these, obviously, but I did divide up the real estate sector, the firms that we cover here as Morningstar, so our analysts cover these, between what we call real estate services. So we've got Lend-Lease and PEXA, recent IPO there. And then, of course, the REITs. So these are companies that own direct property. So they own property. And I put price to fair value, the uncertainty rating, and the moat. So a couple of things that you will notice in here is not a lot of moats. So not a lot of moat ratings in this. So a moat rating, of course, refers to a sustainable competitive advantage. So that's one thing to note. So we do cover a fair amount of different companies here, but only a couple narrow moats scattered in there. So not a lot of sustainable competitive advantage. And then the other thing, if you sort of go through these price to fair values, I'd say they're pretty representative of sort of how we see the market. But of course, a price to fair value divides literally the price of the share by our analyst estimate of the value of the share. So anything that's above 1 represents something we think is overpriced. So for example, Goodman Group, 1.35 means that we think it's 35% overpriced. Anything that is at just 1, we believe is fairly valued. So when we divide the price by the fair value, they're equal. And then anything below 1, we believe is undervalued. So GPT is 7% undervalued according to our analysts. So just want to go through some individual shares that we have in here. Okay, let's talk about the real estate sector performance. So this is both looking at the Australian market. We've got 1-year performance here. We've got 5 years here. So you can see in the last year, the market's done very well, up a little over 31%. Go down to real estate, largely in line. So is trailing by a couple percent. So about 22.5, but you can see across the board, doing pretty well in just about everything. If we go back and we take a longer look, if we look at 5 years, how has real estate done? Well, once again, not quite there. So annualized figure of close to 11%, and real estate's at 7.5%. And we'll talk today about some of the particulars about the sector and what might influence returns going forward, because that's the only thing that we care about. And there's been a lot that's happened with real estate, particularly around the pandemic, that we can talk about. So once again, you can probably start to guess some of the issues that investors have been concerned about when you go back and think about the types of property. Office property, for example. If you're not seeing a lot of people in here with me, that's because there aren't a lot of people in here with me. Retail, if you're trying to go to the mall today in Sydney or in Melbourne, you're probably out of luck. So obviously a lot of things have happened globally around real estate based on lockdown, and we'll get into some of those. All right, so let's talk through a number of considerations, and then we're going to deep dive into some of these. So it's things that we need to think about as investors in this sector. So as I said, listed real estate can offer diversification, right? So all of these real estate investment trusts that we're talking about, the vast majority of them, it's probably all of them, but they own more than one property. So they can own lots of properties. A diversified REIT could own properties in lots of different sectors. So it could own healthcare properties or office, industrial, retail, et cetera. So that gives you a little bit of diversification. Obviously, location, both within Australia and globally. So real estate investment trusts can own properties all over the place. That gives you more geographic diversification. So all of that is nice. Liquidity is an important one as well. That's just the ease with which I can invest and get money out. Obviously, going and buying a individual property involves a lot of work to get it, to find it, to get financing together, all the different things you need to deal with to get a house, to buy a house. And then, of course, when you sell that property, that can take a while as well. So liquidity is a nice thing about investing in REITs. And then generally you get higher income than direct real estate. Now, that is mainly mainly an Australia thing. I'd say that there are, if you look at the US, for example, housing prices have started to go up more, but it is easier to get income out of just buying individual rental property in the US because prices have never appreciated as much. That last one, a couple caveats in there. All right. So when we look at any sector, we have a combination of cyclical sectors and non-cyclical sectors, and then some that are kind of in between. So cyclicality refers to how the underlying companies do based on changing market conditions. So an economic cycle, of course, is the economy gets better, the economy gets worse. So that is, so different companies perform in different in different ways as we go through economic cycles. So let's talk sort of in general. So real estate is considered cyclical. It's considered cyclical because if we think about the different components of it, so from an office space perspective, which we'll get into, the more employment there is, the better it is for the office space sector. The better people are feeling about the economy and the more money they're making, the better it is for the retail sector because people are out there spending more money. So there's all different considerations there. But just remember that real estate is generally pretty cyclical. Okay, so let's talk about the next one. Real estate may perform better in high inflation environments. Now, we'll spend some more time talking about this, but obviously this is of interest right now because there are certainly a lot of indications that inflation is starting to creep back into the economy. It's happening from a couple different areas. We've seen sort of surges lately in energy prices. It's basically a lot of issues, somewhat COVID related and reopening the economy, everything from microchips in cars to certainly energy prices now. But if we do get into an environment with higher inflation, then listed real estate may perform better. So, and we just had a good comment from Stephen on this, which I will go through. So if we talk about this structure, of a real estate investment trust. So technically a real estate investment trust doesn't pay dividends. It pays distributions. And part of the tax status of being in a real estate investment trust is that you do not pay corporate taxes. Now, to be able to be in this situation, you have to pass on 90% of the income that you have. And the whole reason that we have franking credits in Australia is to prevent the double taxation of dividends. And since these are not double taxed because the company is not paying corporate income tax on them, there are no franking credits. So it's the one thing to think about with a yield. And Stephen's saying, which is a good point, some of the stapled REIT securities have both a unit trust and a company in the staple that can pay a frank dividend from the company in the stapled security. So basically what he's saying, and I think Chartered Hall is a good example of this, that yes, there can be situations where there could be multiple sort of REIT securities within this same structure or within the same company. So some would pay, or the corporate entity could pay franking credits, but something to look out for. So even though we'll see that yields are higher for some of these securities, it's obviously up to your own tax situation and sort of where you're holding these. But you could see situations where, that yield differential is made up for with franking credits that obviously raise the implied yield. Interest rates and higher interest rate environment. So yeah, we'll talk a little bit about this. There's some interesting things around higher interest rates that we'll have to think about. But if we think about REITs in general, generally higher debt. That's how they're financing a lot of these either acquisitions of buildings or potentially building something themselves. So they tend to have higher debt. That means there is generally, obviously, higher borrowing costs when interest rates go up. The one thing is historically, and we'll show a chart on this, historically, if you go back and look at distributions, they have held up pretty well. But the other thing you have to consider, of course, is they could be less attractive to investors, right? So in higher interest rate environments, investors could get more for investing in just bonds, for example. So they may not take on higher risk to try to get yield from a real estate investment trust. All right, we'll talk a little bit about this one too. So there is a fear that the pandemic may have accelerated trends that adversely impact listed real estate. So obviously I gave the example here that there is nobody in the office today with me. There's actually one person in here. So there is worries, of course, that people have gotten very used to working from home and they will not want to go back to the office. So that's one component. So particularly if you're invested in office real estate. The other component is around retail, that people have obviously gotten very used to ordering things online, and that might have accelerated the trend to a greater percentage of retail shopping coming from online versus going into stores, which of course would impact anybody that, or the retail space for real estate investment trusts. Now we'll go through some of the different considerations there. There are certainly some trade-offs, including like office density that our analysts have talked about. But yeah, we'll go through that. And then finally, active management. So active management, of course, is a manager's going out there and selecting the individual securities that will go into a fund or an ETF. Active management and passive, which is just following an index. We do a report called the Global Market Barometer, where we look at every sector and we look at the success rate of active managers. And in real estate, they tend to have higher success rates than most other sectors that we cover. So we'll look at that. All right. So first, we're going to talk about inflation. So this is a little bit of a confusing chart, but I think it's a good one, personally. So I took this from a First Links article that was looking at how different asset classes perform in inflationary environments. So the chart's a little bit busy, as I said, but let me try to explain it for you as I shuffle through my papers. I have an explanation somewhere in here. Okay, so here's what we're looking at. So if we look at the lettered columns, we can see that we are looking at the returns of different asset classes within different environments. So I know this is pretty small, but basically what we're looking at, and I'll point out the important part, we're looking at Aussie shares, we're looking at US shares unhedged for AUD. We're looking at Aussie listed property. We're looking at Aussie housing, so just general housing, so direct investment into housing. We're looking at government bond yields, Aussie, US. We're looking at cash, and we're looking at precious metals, so gold, platinum, silver, unhedged. And what we're looking at here is how each one of those asset classes perform in different environments. So the important thing that we're looking at here is high inflation years. So basically what they did is they looked at the average returns for each type of assets in periods of high inflation, moderate inflation, low inflation. So high inflation was defined as above 5.4%. And that is the highest 1/3 of years since 1900 in Australia. Low inflation is defined as below 2%, the lowest 1/3 of years in Australia. And of course, moderate inflation was in between the two, so between 2% and 5.4%. So what you can see in high inflation years, listed property had the highest return. Now, the other very important thing to remember is all of the returns go down in high inflation years, right? So if you look at every single asset class, not doing great here compared to low inflation years. So something to remember, that everything does come down, but listed property is on there. Now, why is listed property? Well, a couple different things. So number one, some, not all, but a lot of leases, particularly around sort of office leases and retail leases, have an automatic inflation escalator in there. So basically just saying that, we will add CPI to rent so that they can be increased as inflation increases. So that's one thing to think about. The other idea is that in high inflationary environments, people are less likely to go out there and build new buildings. And it's because the costs go up so much. So whether that's labor costs, whether it's all the commodity costs, everything else, the material costs that go into buildings. So you tend to see a fall in construction, which of course is better for you if you own buildings. So yeah, a couple different things that do tend to benefit listed property. Now, you have to think very carefully, of course, about where in the sector, particularly if we move over to those services. If you're building buildings, if you're a developer, you're not necessarily owning the buildings, you're just building them, like lend lease, for example, that could be a problem. So, obviously all those higher construction input costs and everything else would impact you. But yeah, a couple things to think about if we start moving into inflation. And this is sort of true across the board, right? When we say, and we're just looking at real estate today, but in inflationary environments, companies that own real assets tend to do okay. And I guess the other side of things, of course, is the debt side of things. So they tend to take on more debt. If that debt is fixed rate, certainly, an inflationary environment can kind of monetize that debt. Basically, what that means is obviously if the purchasing power of dollars decrease and you have a bunch of debt, that's good for you because all of a sudden your debt is in real terms worth less. All right, so the other thing, we talk about incomes, is what I alluded to before. So this was a S&P study, so it's a little bit dated. So this is in 2017, but basically what they did is they went back and they looked, as you can see here, at how inflation performed, or how income performed versus inflation. So what you're seeing here is, of course, the ability to pass on inflation. So pass on, whether that's contractually pass it on or pass it on just through regular rising rents, higher than inflation. So income is outpacing inflation, which is a very good thing. So we do have a question. Sorry, I'll go back to this other slide. Now we're going the wrong way. We're all over the place. All right, so we did have a question saying PM. What does PM stand for? Precious metals. So precious metals on there is gold, platinum, silver, unhedged for the Aussie dollar. So you can sort of see it across here. So, one of the conclusions, so it's a good article, actually. So if anyone wants a copy of the article, so it's written by a third party that we published it in our First Links newsletter. And it's looking at all these different asset classes. I took this just because I wanted to talk about listed property. But of course, it talks about how other asset classes perform in an inflationary environment. We'll do a webinar coming up on this, but if anyone's interested in reading the article, send me an email. One of the conclusions in the article is basically precious metals don't do that great. And that many people think that precious metals, owning gold, for example, is an inflation hedge, but you can see, frankly, it doesn't do great in any environment. But you can see the impact of that. And so, yeah, so that's that one. Let's move over here. So let's talk about rising interest rates. So interest rates are obviously an interesting one. Inflation and interest rates tend to go together, number one. So, we can't actually isolate each one of these elements. But in rising rate periods, we can see that REIT performance, so this is in the US, between 92 and 2017, that you did have real estate investment trusts still have positive returns in 80%, 87% of the rising rate periods. Now, part of this also is we can't look at rising rates or inflation in isolation. Both of these things happen generally when the economy is doing better. And of course, when the economy is doing better, as I said, these are cyclical securities. So as there's more hiring, that's better for retail, that's better for office real estate, it's better for residential property. All of it's better if people are feeling, if people are out there continuing to make more money. So, so even though there are some negative effects around certainly around borrowing costs, there are some positive impacts as well. All right, moving right along. Okay, so let's talk a little bit about the pandemic. So our analysts, of course, looked at this notion that we are hearing everywhere that nobody's ever going to come back to work. And obviously that's a little bit of an exaggeration, but even if we move to, 3 days a week in the office, 2 days a week at home, anything like that is obviously going to impact office. Now, there are two things that our analysts like to look at. They do not believe that the impact of this will be as severe as it was initially thought. And if you've looked at a lot of the office real estate investment trusts, they've rebounded. I think very early on in the pandemic, there was this notion that nobody's ever going back to work. And you still see these articles all the time. But they're looking at two other factors. So one factor is office density. So, of course, office density over time has been dropping pretty significantly. So what this chart over here is looking at is, it's looking at the square meters per, and they looked at the finance industry, per finance employee. So really the idea was, and I've certainly seen this in the past couple of years, the idea is we'll just cram more people into the office. So companies did not want to pay for more office space. So all of a sudden, we've seen this happen. There used to be offices that people would sit in. Now there's no offices and everything's open plan. It's hot desking. It's just trying to get more and more people into an office. So we've seen over a long period of time, a 10-year period of time, we've seen pretty big drops. Now, our analysts believe that this is going to go back up. Now, part of it, of course, is going back up as we all need more space right now from a COVID perspective to, stay away from people. There's ideas about not using hot desking anymore. So basically hot desking is the idea that you don't have a desk, you just show up and sit wherever you want. But of course, just from cleaning procedures and things like that and sharing keyboards and all of that, you guys know this whole story, but they believe that this will reverse. They also are looking at the office supply. So looking about the supply that's going to come online compared to the percentage of total office stock, and they see it as being pretty low. And they think that both of these factors will mitigate any of the impact from less people returning to work or returning to work less often. So that's what our analysts think. I would say it sort of appears as though the market believes that as well. As I said, there's been this rebound. But yeah, certainly something to think about. We have seen, I think throughout COVID, the acceleration of all sorts of things that were probably happening anyway. I think our analysts are sort of less positive around retail. Yeah, the idea that online shopping has sort of taken hold and accelerated beyond what it would have without COVID. That's certainly an impact as well, right? You don't want to be that guy that went to 12 barbecue stores and infected all of Sydney. Of course, that one didn't work out. I like the limo driver. All right. So let's talk about active management and sort of how we go out there and source this investment. So obviously I put up some direct securities you can buy, but of course you can rely on a manager. You can buy ETFs or funds, and you have to make a decision whether you want to go active or passive. So what this is is this is the Morningstar from our active passive barometer report. So what it's doing is it's looking at all these different categories. So this isn't sectors, they're investment categories that we divide funds and ETFs up into. So it's looking at all of these different categories. And it's looking at the active fund success rate. So if we take all the active funds in that category and we compare it to an index, how well are active managers doing? So right here, first of all, we all know you should not go into a high cost fund or ETF. That just does not work out for anyone. But if we look at the lowest cost, so if we do sit there and we do take cost into consideration, and we look at the lowest cost, we can see these are the percentage of active managers that beat their benchmark over a 10-year period. If we go down here and we look at US real estate, that's our highest percentage there, right? 62% of managers were able to beat the index, and pretty good for global as well. So we're behind, we're below 50%, but yeah, pretty good as well. So of all the different categories, and you can see some other ones are pretty high, of all the different categories, that is potentially an opportunity to use active management. And of course, we don't have any specific reason why active managers have done better, but some of the reasons include, in general, is that this indicates a less efficient market, meaning that the prices do not reflect values. So a more efficient market, they would both be pretty similar. But in this case, because humans are able to go in there and pick out securities and beat the market in these areas, it does indicate that it is less efficient. And that could be, number one, because it's a smaller sector overall, so there's probably less attention paid to it, less analysts looking at every single one of those companies. It is easier, I think, within the real estate sector, it's pretty diverse. Right. So whereas a lot of other sectors may be more correlated, if we look across all the different types of real estate, that your ability to figure out, okay, healthcare represents a good opportunity now. Oh, no, I want to shift that to retail. So you do have more freedom to sort of move around because it's a smaller sector, as opposed to if you're investing in giant, well-watched sectors. So those could all be indications, but there is potentially an opportunity for active management there. No, that's just the key. All right, so let me show one more thing, and then there's a couple questions, which I'll get to. So yeah, if we're talking about funds and ETFs, so I've gone onto our website now. So simply if you're looking to find them, so if we're looking for active management, as we said, we're looking for funds. We just go into Australian listed property and then global listed property, and we can see all of the different funds and ETFs that Morningstar rates with gold, silver, bronze, so our highest rating. So you can see some of the Aussie listed property there if you want to go the fund route. And then if we want to go into global listed property, you can see a larger selection, different opportunities there. And then finally, of course, if you did want to invest passively still, I can go back to where I thought it would. If you do want to invest passively, we can just switch to passive, and there are a number of ETFs. So there are no active ETFs that we give a gold, silver, bronze rating to, our highest rating in either of these two asset allocation buckets, but there are a lot of passive. So you can go through and see some of the different passive opportunities that you have if you're interested in real estate. All right. So let's answer a couple questions. Yeah, so John's saying, would you share this presentation? Yeah, absolutely. So anyone who wants this presentation, just send me an email. It's mark.lamonica1@morningstar.com, and I will send it along. And also that article, if anyone's interested in the article. Okay, so John is asking uncertainty rating. All right, so that's a good question. So let me go back to the deck. We'll talk a little bit about uncertainty. And I should have spent some more time on how our analysts' ratings work. Okay, so what are our analysts trying to do when they are defining or when they are estimating the fair value of a company? So once again, the fair value or the value in any share comes from cash flows that are generated in the future. So what they're doing is they're estimating out those cash flows, or discounting them back to the current day using a discount rate. Now, they, of course, are, making an educated guess, but they are guessing. None of us knows what happens in the future. So I think that there is a lot of precision that's implied just by a discounted cash flow model, which is what they're doing. But all the inputs into that model, of course, are things that occur in the future. So what they do with an uncertainty rating is they rate the certainty that they have in those cash flow estimates they're making. Now, what could lead to higher uncertainty? Well, very simply, the structure of the company, the industry that they're operating in. So if a company has a lot of debt, for example, that would be higher uncertainty. If a company is faced with a lot of commodity price risk, for example, that's higher uncertainty. If they're operating in politically unstable countries, that's higher uncertainty. So basically, depending upon the different things that could go wrong that would impact a company and impact those cash flows, the analyst will put a higher uncertainty rating on it. And what you use those uncertainty ratings for is to have a bigger margin of safety when you're investing in higher risk industries or companies. So, pretty simple. And the example that I always use is, if you are a consumer defensive company and you're making Coke, right? If you're Coke, you're going to have lower uncertainty. There's more predictability about what's going to happen with Coke next year. They're not going to sell, as I always say, they're not going to sell twice as much Coke next year, but they're also not going to sell half as much Coke next year. So they've got an established brand. They are globally diversified. They are in good financial shape. They have a good that isn't really impacted by the economy. There isn't around a lot of cyclicality around Coke. It's not a huge part of what everyone spends their money on. So all of those factors could lead to lower uncertainty. Where on the other side of things, if you have a highly cyclical company that's very dependent upon the economy, that is a smaller company that isn't diversified in terms of product lines or areas that they operate in, if they have really high debt, if they have little control over their pricing, right? If they're price takers, which means like they could be a mining company, right? Where they don't get to decide how much iron ore sells for. They are going to take whatever price is out on the market. And we've obviously seen a giant drop in iron ore, just as an example. All of those things would would give our analysts less certainty. So they would give it a higher uncertainty rating, which we would then adjust in the margin of safety. Anyway, thank you guys for joining. So as I said, we've got 2 webinars coming up on Thursday. We'll do micro cap and small cap investing. And then we'll also talk about how much money you need for retirement. So if anyone needs invites to those, let me know and we'll send out an email on Thursday morning. So thank you guys very much for joining.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.